Welcome to Get Rich Education. I'm your host, Keith Weinhold. Don't save for retirement. If you do, you're probably going to struggle in your life longer than you need to. And what does retirement even mean in this day and age? Also, some lessons for children and money today on Get Rich Education. Finally, with Total Control Financial, get checkbook control of your existing 401k and IRA funds to invest in real estate. Yes, you can move your retirement money into your own checking account, but you must avoid the little-known tax that you'll get hammered with in a self-directed IRA. Instead, start your QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to Get Rich Education. I'm your host, Keith Weinhold. Don't save for retirement. What we're talking about here is don't save for retirement in a plan specifically designated as a structured retirement plan like a 401k, 403b, IRA, or thrift savings plan. Otherwise, you're probably going to struggle in your life longer than you would need to otherwise. Today, you're going to hear some things about retirement that you've never heard before. Before we get into that, let's talk about a few instances where it might make sense to contribute to one of these conventional retirement plans. A while ago, a listener to this show, Jordan, asked me, is it worth it to contribute 7% of my salary in order to get a 7% match from my employer, also known as a 100% return, even if this money is locked away and can't be utilized for decades? Great question, Jordan. My answer is, it depends. It could be worth going for the match. Yeah, go for the match if you're confident that you'll be able to truly enjoy it in your 70s. Of course, you can never really know that. It has more to do with your health than it does anticipated returns or anticipated tax treatment. And now anything beyond a 7% contribution to his salary gets no match. So yeah, anything beyond 7%, I can't make a case for contributing there at all. That would make almost no sense. Even though I'm not a fan of the 401k, see, I can look at a case for taking the 100% return if your employer matches that dollar for dollar. Indeed. See, there's something out there in society where some people feel the need that, they just have to see everything as black and white. For example, either Trump does everything right or Trump does everything wrong. And I can never give him any credit or any blame. Either the New York Yankees can do no wrong, or the New York Yankees are the evil empire, so they do everything wrong. So people that fall into those camps, they're divisive and they really turn their mind off. So it's not black and white with the 401k and so many other things in your life. Now, I know we had a guest on the show a couple months ago that wouldn't even participate in the match portion at all. He told you why on episode 276. So why aren't I a fan of the 401k? I think you know that it's because, in short, instead, you could invest those funds in something where you get paid every month now without having to sacrifice your future one bit. If security is what one seeks with their finances, well, security is not my favorite word because it's not aspirational. But if having a stable job makes a person feel secure, then consider how much more secure that person would feel when they have multiple streams of income. think of that as the new security, if you will. Let's talk about not saving for retirement with this week's guest. And I'm sure that I'm going to have some more fresh angles to bring to you about this right after our chat. Daniel Ameduri is a self-made multimillionaire. He describes himself as a full-time skeptic of conventional thought, which I love. And he's a proud father of 3. He's a husband. He's a co-founder of the Future Money Trends newsletter and futuremoneytrends.com. And you got to hand it to him. He has nearly 150,000 subscribers to that popular newsletter. It's really one of the more widely recognized authorities on investment ideas and economic advice. And he's been featured in a lot of publications that you've heard of, like ABC World News Tonight, the Wall Street Journal, even on Russia Today TV. He correctly predicted the collapse of Lehman Brothers, AIG, and Washington Mutual on Vision Victory, his YouTube channel that he launched in 2007. And he's had millions and millions of views there. And he did have that prediction published 6 months before it occurred. Welcome to Get Rich Education, Daniel Ameduri.
Hey, thanks so much for having me on the show.
Daniel, when you were 27 years old, that was about a decade ago, you were on the brink of bankruptcy. A decade later, you're a multimillionaire. So I got to hand it to you. It's like the old Jim Rohn quote, formal education will make you a living, self-education will make you a fortune, because you really drilled down and taught yourself about economics and investing and things that you never learned it either at school or at home. And you give a lot of guidance for that in your book that's got a great name. I love the name of your book. It's called Don't Save for Retirement. And before we go on, let's talk about how you define retirement. I think it's an interesting word. And, a lot of people think about retirement as some magical land over the rainbow that's typically decades away. So what do you think of as retirement? What's that even mean today?
God, that's a great question, right? When I made the title, Don't Save for Retirement, our alternative, I'll do a spoiler alert, is to focus instead on financial independence.
Yeah.
And essentially a retiree that's successful is becoming financially independent. The problem I see for them is that they're just doing it in a really bad way, a long way, a speculative way. They're putting their money in IRAs and 401ks. They're completely speculating in the stock market. They have no idea what they're doing. They have no idea why it's up or down. They're being feed to death on the way. And so I think the don't save for retirement, for me, my definition is really don't save for conventional retirement.
Yeah.
Certainly, there are many things and assets that we want to own and that we can get to cash flow and build a passive income portfolio. But this idea that it's very unfortunate the population has been conditioned to believe that they have to work for 30 to 40 years before they can actually be financially independent, which, as you know, you can do it in a lot less time.
Yeah, it took me 12 years because I never really lived substantially below my means. I think some people, including you, have done it faster because you took that focus onto residual income in the today rather than deferring everything until tomorrow. Yeah, you know what I often say, Daniel? It's kind of funny in society when it comes to the time versus money thing. People spend all this time learning about how work works. They don't spend any time learning about how money works, but yet money is the only reason that they even go to work. What are your thoughts?
Yeah, and it's our school system, right? And it's horrible. I mean, the kids are not learning about money. They're not learning about credit. They're not learning about investing. They're not learning about any of this stuff. The only thing they are being conditioned to the point where it's like a trained animal is that they get 2 15-minute recesses and a 30-minute lunch. And that is what they learn. They also learn that they need to sit down, shut up, and let the government bureaucrat speak over them and tell them what to do. And don't talk out of line, all this stuff. Like, I mean, I'll be honest, my kids are homeschooled, and it's a privilege. Believe me, I'm not advocating that one way or the other is better. It's all about what the parent can teach, because your kid can go to school, they come home and you guys play Monopoly and cash flow and read Rich Dad Poor Dad, and it's going to be fine no matter what. But I mean, I literally took my kids out of the school system because I was like, you know what? I honestly think they would be more productive, not only engaging in what my wife and I do as far as investments to go, but also just unleashing that creativity and letting them play for hours and hours and hours in order to have that mindset later in life of that desire for freedom. Because a lot of kids, I think they just fall into college and school and work because they're kind of been conditioned to accept that fate. And I think people like you and people like your listeners, obviously they're listening to the show, they're resisting that fate. And a lot of us didn't know what to do. We knew something was off, but we didn't know what to do until we read a book like Rich Dad Poor Dad or something. So I think it's great that, there's shows like this now, and it's accessible to young people, especially, because you're absolutely right. They're not getting any financial education at school at all. If anything, they're getting a bad financial education because they're being taught to not set a higher goal for themselves or have a higher expectation for their life.
Yeah, I think being a conformer, that's really one theme here from childhood all the way through high school and college. It's conformity that's rewarded. And then when one gets out in the working world, the reason I think a lot of people don't take an interest in finances is because they just make a false assumption. For example, well, no matter what, I've just got to work until 70 or whatever age. And most don't even ask if 401ks are where they should invest because they just assume that that is the place that they should invest because there's no friction there. In fact, your employer will even opt you in to a 401k plan a lot of times anymore where you need to take intent to go ahead and opt out. So I really think it takes intent in being a non-conformer to know more. I don't think the 401k is a completely bad vehicle, even though I dislike 401ks, because for some people, if it weren't for the 401k, they wouldn't have any money saved and they might be squandering their money along the way. But really, there's a great opportunity cost if you're only investing in the 401k and you don't take that intent to learn about bettering your finances. What are your thoughts?
Yeah, I mean, the 401k to me is a real risk for people that they don't factor in because, yes, the stock market is risky and it's potentially a big bubble right now. And yes, there are fees, but there's one even bigger thing that nobody pays attention to and nobody's focused on for some reason, and that's the federal income tax. You have no idea what your withdrawal rate is going to be. It's like taking money from a bank and walking out with a loan, but not knowing your interest rate. And that is essentially what people have done. When you defer the tax, by the way, which we are at the lowest tax in like 100 years. You could claim that the 80s was equal, but really it's like since 1931, taxes federally haven't been this low. So you're avoiding paying the lowest taxes in a century, and you're choosing to just gamble that taxes are going to be lower in 20 years or 30 years or the same. Let's be honest with ourselves. With the national debt, the demand from entitlements, the new demands from many people wanting to not even have student loans or health care. So let's be real. Are taxes going to be higher or lower? They're probably going to be much higher. So that's an even bigger risk that people aren't even factoring in. You got fees on 401ks. You have no idea what the stocks are doing or more likely what you're even buying. And then to top it off, you don't know what your withdrawal rate is. And when you do withdraw, if you did it early, they're going to give you a 10% penalty on your own money.
That's right. That's a good point. A lot of people invest in 401ks because they see that they can defer the tax and that way they get pre-tax dollars compounding, but that's quite faulty on a lot of levels. If you're deferring the tax, well, right now you have a bird in the hand with relatively low tax rates historically. You're deferring that until you need to pay a higher tax rate later. And another thing I think a lot of people overlook is if you had money, say you just did want to invest in stocks and mutual funds for some reason, they wouldn't pay you any income, but you are then subject to only the long-term capital gains tax, which is substantially less than what ordinary income tax rates are. And you need to pay ordinary income tax rates on your 401k when you defer it, that higher rate.
That is a great point. As you know, there are alternative investments that people could still benefit from a lot of tax benefits and grow their asset base in the real estate market. But, we have been conditioned that a diversified portfolio means you're 100% in the stock market. They'll say, oh, we have REITs and international REITs, and we have commodities, and we have exposure to all these markets with all these mutual funds. But let's be real. Look at 2008. It didn't matter what you owned. It all went down together. And let's be real. Even if you owned gold in that environment where gold was one of the things that had a positive year in 2008 and did well, the gold stocks got destroyed. So a stock is a stock, no matter what sector it's in.
That's right. Most people view diversification as being diversified in a number of different mutual funds because they're just not thinking about investing and they just haven't widened that scope to other investments, including ones that pay income. We're going to talk more about that with Daniel Ameduri. when we come back here on Get Rich Education. I'm your host, Keith Weinhold.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
Welcome back to Get Rich Education. We're talking with Daniel Ameduri. He's the author of a really thought-provoking book called Don't Save for Retirement. It's a title that I absolutely love. Most people are saving specifically for retirement in a 401k or another type of deferred compensation plan. That's what they're called, deferred compensation plans. Just think about how attractive this might sound to somebody. The word deferred means to put off an action until a later time. The word compensation, that means something, typically money, that's awarded to someone as a recompense for a loss, an injury, or a suffering. Basically, what you're saying by investing in these things is that in 30 years, we're going to try to make up for what you've lost when you were younger. So you're kind of selling your todays in favor of tomorrows and thinking that the compensation tomorrow is going to be so much better for what you're giving up today. I think there's a better way forward. What are your thoughts?
I couldn't agree more that there is a better way forward. First of all, if you defer and you put the money in the 401k, there is a penalty to withdraw it or use it. It's not that accessible. Now, somebody's always going to give me a technicality and say, oh, I can borrow 50% of it or something like that. But let's be realistic. For most 401k plans, people who might not have some sort of government one, backed sponsored one, I'll give you a simple example. I own a duplex and it pays me a dividend, a yield every single month. And I'm able to take that money and use it. And I can use it on whatever I want. I can save it. I can compound it. I can spend it. I can use it to buy food and eat it. I can do whatever I want with it. And I'm 38 years old right now.
Yeah.
I don't like the idea of reallocating the money to a 401k or some sort of vehicle like that, like an IRA. And then I'm not going to have access to it for 20 years. It's really unbelievable that we were even ever convinced. And another thing I should mention with the 401k and IRAs, these have not been around that long. Retirement itself hasn't been around that long, especially modern day retirement. The 401ks were passed in the late 70s and introduced to the public in the 80s. So consider that this is an experiment. Now, the next question is, how is the experiment gone? Well, let's see. The baby boomers had the best real estate market, best stock market, best bond market. This group should have really just crushed it on the 401ks. And according to Vanguard, which is the biggest manager of these accounts, the median account holder for someone 65 or older, it's at about $55,000. Again, they had basically a royal flush on being able to save for retirement. And it wasn't a big success. It's not a big spectacular fireworks show success. In fact, if you go back to the most basic fundamental pitch on a 401k, it's that you will be able to pay lower taxes in your senior years. I don't know about you guys, but I don't want to pay lower taxes if it means that's because I'm not making that much money or I'm
Right.
I want to be in the highest tax bracket when I'm 70 years old.
I think maybe another way to say it, I know you invest in real estate like single family homes. You mentioned the duplex. With the duplex that you own, you're given certainty because you're given an income stream every month. Yes, there's the appreciation on the asset, especially if you're leveraged. That's good too. But let's just talk about the fact that with the duplex, you have certainty. And with a retirement plan, all you really have is a promise. Because think about the mindset when one retires, if they never got into the habit of purchasing income producing assets, well, then say someone retires with a pot of $1 million. I think we know that's not a very great retirement preparation if you only have $1 million. You brought up some statistics. I know it shows that a lot of people at retirement age, whatever that is, they don't even have $1 million. But if you didn't program income into your mindset, what if in that first year of retirement, you want to break $50K off of your $1 million retirement pot? Well, now you're down to $950K, and you can just see how this is going to go. You have the mentality of scarcity, of there's not going to be enough. I keep chipping away at all I have because that income producing mindset was never started.
Keith, you tapped into something I've never heard anybody talk about ever. And that is huge because I do know a few successful retirees and they live in a prison. They are living in an absolute mindset of scarcity because they have exercised one muscle for 40 years, and that's save. And that is one of the things I talk about in the book, Don't Save for Retirement, is I tell people when you get your first passive income check or first dividend check or however you built passive income, I want you to take some of it and spend it. I want mine, I always tell in the book, I paid a water bill. Take it to Ruth's Chris, do whatever, but you have to train the brain and already adopt the retirement lifestyle now. The passive income lifestyle where, yes, of course, especially in the early years, we're going to be rolling as much as we can back into passive income to buy more. But at the same point in time, you have to get into the practice of actually treating that income like income. Imagine if you went to work and your job paid you, you had trained your brain to never touch it. You would live like a poor person. Well, that's what's happened to all these retirees that were successful.
Yeah.
Yes, they have the savings there, but they're not touching it because it's like ripping a chunk of meat off their body.
That's another way to think about it for sure. When one focuses on that residual income, they're really sowing and harvesting the seeds of financial freedom starting when they're 26 or whatever it might be.
Absolutely. And it's so healthy. And it's what the rich do. Where I started my research was really trying to mimic the rich. And what I realized was the rich focus on income and they focus on preservation. When Warren Buffett talked about that the number one rule is don't lose money, number two rule is don't lose money, a lot of people are confused because stocks go up and down, real estate can go up and down. That's not what he meant. He doesn't mean avoid volatility. He's talking about don't lose your money. So I'll give you an example. I'll just use that same duplex as a perfect example, actually.
Yeah.
I bought it in 2006 for $120,000. The duplex by the end of 2008 was around $65,000. It had dropped 50%.
Wow.
Here's what's interesting, and your listeners will love this. The rents actually went up because all of these foreclosures, it made the rental demand through the roof. It was a great time to be a landlord from 2009 to 2013. It's a great time now, but I mean, really great time. Rents were on the rise because there was just a flood of renters entering the market. Now that duplex today is about worth $130, but let's say it didn't even get there. Say it just got back to the $120. That is what Warren Buffett's talking about. The risk of me losing all of my money in real estate is zero. The risk of me losing all of my money in a stock is possible because these are businesses that you have your Enrons from time to time. You have your Bernie Madoffs. You have severe stock market crashes, which are down like 70%. And of course, the advantage to real estate is that duplex, it's not like I had $120,000 in the deal. I had like $20,000 in the deal. So even though it swung up and down, I was leveraged. I was benefiting from depreciation on taxes. And I actually saw my income go up at a time. So income growth, and I also preserved my money by having it in something safe.
I am so glad that you brought up this story of the duplex and put some real numbers to it. Because right around the same time, 2007, which would end up being an awful time to do what I did, I bought a fourplex building. It was the second fourplex building I bought. I paid $530,000 for it. About 2 years later in 2009, it had fallen in value from 530 down to 480. And I'll tell you, Daniel, I was scared. I saw mortgage companies going out of business when we saw the implosion in the bond market. And I knew that people couldn't get loans for properties anymore. I was so scared that I asked myself, should I sell this fourplex? I lost $50,000. It seems like there isn't going to be any bottom to this. And when things have bottomed out, you never know where the bottom is truly going to be. When I realized that no one else could get a loan to buy the property from me, next I realized that, no one else can go get a first-time home buyer loan. And that's why my rental demand, therefore my rent income went up. So my point is, when you're in a multifaceted asset class like real estate and you're paid so many ways, you can play different sides of this. I didn't have to sell for a capital gain because my income went up, and I could sell down the road for a capital gain if I wanted to, but I don't have that pressure because I've got that income stream.
Absolutely. And just to the readers as well, the cash flow properties I still own in the '08 crisis. The ones that I bought for appreciation became a living nightmare. Short sales, foreclosures, and an epic disaster.
Right. That's a great point. These are some of those long-term lessons that a lot of people aren't thinking about, because the crisis is now 11, 12 years ago. So we now have a generation of listeners that haven't experienced anything like this before, and the importance of buying for income predominantly.
Yeah, it's so funny. For those of us who went through it, feels like it was last year. Scarred by it, and we do so many things more conservative, which I think is why there won't be another epic crash like that in the near future, at least, just because the bankers, the mortgage brokers, the appraisers, that scar is pretty deep on all of us right now. And I don't think anybody's getting over leveraged or going crazy here.
That's right. I know in your book, Don't Save for Retirement, it says that most people's investment strategy is stuck in the 1980s. What did you mean by that? Maybe we've already touched on it, but are there any other thoughts, sort of these antiquated notions that people have that never get changed a generation or two later because people never get formally educated on finances? What are your thoughts?
Sure. I mean, let's look at the bond market. In the 1980s, bonds were yielding anywhere from 10 to all the way up to 18%. People will have this allocation of 1980s portfolio where I'm going to be 70% stocks and 30% bonds. And then I'm going to do some math and deduct my age and retirement, all these different gimmicks the brokers have out there and the mutual fund companies. But let's be real. The bond market has gone up for 38 years straight. And there's really nowhere else for it to go. It can't go up anymore, maybe a little bit more. But I mean, there's only one direction. So why would people assume that bonds would be a safe or even something worth allocating in your portfolio right now? And then on the mutual fund side, it's so deceiving. These companies pump out mutual funds. They close them down like they never happened. And the brochure shows, look at our top 5 funds have outperformed the market for the last 5 years. But what they don't show you is the other 45 that they've gotten rid of. They don't even exist anymore.
That's right. And they're not included in the average anymore then either.
No. And so that is the 1980s portfolio that I'm just going to buy a basket of mutual funds, and I'm going to get really lucky because internet was created. And then the baby boomer demographics were ideal, where you had the largest generation in the history of the United States, which dwarfed the generation before and after. They were having children in the 80s. If you look at the first baby boomers born in 46 and just do the math, when they start to have children and they start to have families and they start to buy homes, this is all starting to happen in the 80s and 90s, where it's swelling. The spending was through the roof. Consumerism was through the roof. Those same scenarios are not there. It's a much different economy, as everybody's experienced. It's a freelance economy. It's a more mobile economy. There are many great things about the economy. In fact, as a millennial, I love our economy.
Sure.
Because I'm home right now. I'm home every day with my kids and my family. And if I want to go to China tomorrow, I'll go to China and bring my laptop, and the business comes with me. But it's just a much different environment. And I think we need to cater and realize that this cookie cutter idea of retirement or investing, it shouldn't be cookie cuttered. And it hasn't been around that long. If you think that people were investing in 401ks 100 years ago, or that Adam and Eve had a compensation plan, it's not true. These things are new. And the experiment, in my opinion, has failed.
Don't turn your income into savings. Turn your income into income.
Income. Yes, I always teach that to my kids. And I've always looked at it as buying income. I'm going to go buy more income.
100%. Any other lessons or takeaways for kids? Maybe kids aren't ready to hear things like don't live below your means, expand your means. Do you think it's good for kids to do a little bit of savings in order to get in that habit, but not too much? What are your thoughts there?
Cambridge University did a study that people develop their personal financial habits by age 7 from observation of parents and, of course, talking about it or not talking about it. So I highly encourage people to educate their children, talk about it. Let them use the debit card at the gas station. Let them use the debit card at Target. Encourage them to shop for the best price if they have birthday money. And my rule around my house, if they get birthday money or Christmas money, they have to save 50%. And then don't take them to the store right away or allow them to go on Amazon. Don't feed into that instant gratification. Let them shop it. And if it's inconvenient for you, it is what it is. Go to Target and then go across the street to Walmart and teach them to get the best price. Play games, the Monopoly, cash flow. There's another game, a card game I play, Net Worth with my kids. Let them just absorb all of this and really encourage the conversation. My kids treat the show Shark Tank like church. We have a blast. We put the TV on pause and we talk about the deals or how we hate this company or why this company is great. And lastly, I would just say, teach your kids about how money is created, and that's delivering value to other people. So perhaps when you leave Costco or Disneyland, you can turn to them and say, hey, what do you think about the business? What made them special? Why do you feel so great when you leave Costco, even though you just gave them $500? Why do you feel so great about Disney? And talk about what makes a great business, because that ultimately, whether you're an employee or a business, you have to over deliver more than people pay for to do it great. And then on the flip side, occasionally we were at a store a few years ago, I guess it was in Italy, and my daughter's toy broke within like a minute after leaving the store. We went back. They would not refund. They would not transfer. And I went out and I'm like, what do you think about that business? What's the difference between that business and Disney? It's a fun thing to do and just get the conversation going.
And what you're really doing is you're telling them that there does not have to be this one path, this one financial path with rigid conformity, which is where we started the chat today. Daniel, if our listeners want to connect with you, let them know how you can help them and what is the best way for them to do that.
I would love for them to go to futuremoneytrends.com. And if they want, go to futuremoneytrends.com/save. You'll get our weekly wealth digest free, as well as you can read the introduction of the book, which starts with me and my wife in a bankruptcy attorney's office in '08, as well as the first chapter of the book on my own personal definition of wealth.
Daniel Ameduri, it's been a fun chat. Thanks so much for coming on to the show.
Thanks so much, Keith.
Wow, great stuff from Daniel here today. Consider this. This is how conventional financial planning tells you that your retirement is supposed to look. It's about the 4% withdrawal rate that you're supposed to make annually from your pool of savings in retirement. And I know that there are both advocates and detractors of the 4%, even within the conventional finance community. But just consider that when one is in retirement, they're basically saying that if a client takes out more than 4% of what is in the retirement plan each year, well, then they risk running out of money. So that means if you have $500,000 in your 401k, then you can take out about $1,700 per month safely without running out. I mean, what a joke. Would you be able to survive on $1,700 a month in retirement? And we didn't even address the taxes yet. What was all of your work for if you have to live broke like that? Even if we double or triple those figures, things would not look all that great. Is that what you're setting yourself up for? I mean, fortunately, you as a listener to this show are not setting yourself up for that. Another angle to this is whether you have a financial advisor or not. Now, there are some good financial advisors out there. Don't get me wrong. We've had some good ones on the show before. But do you know what I think that the major role of a financial advisor is? This is it. The chief role of a financial advisor is to keep a naive person from losing all of their money. That's about it. Well, what's the better plan? The better plan is what we do here at Get Rich Education. Help the naive person lose that naivete so that they don't have to rely on some other individual for the wealth. Because look, for those that have a traditional money manager and then that person becomes enlightened, they've got to be saying, my gosh, Mr. Money Manager, let me get this straight. In retirement, you are going to collect your 1% fee on my money so that I can safely take out 4%. So that means that you then get 25% of what it took me 30 or 40 years to accumulate? No thanks. Well, many people exactly settle for that arrangement. Some pay a 2% annual fee to a financial advisor to withdraw 4% of their savings pot at the end. That means the advisor takes 50% of what it took you decades to accumulate. That is just like going to an ATM and paying a $10 surcharge to get access to your own $20 bill. And on top of all this, people have longer life expectancies now than when 401ks first had mainstream adoption decades ago. To summarize today, retirement accounts are life deferral plans. Don't save for retirement. You're selling an hour of your youth with the mere hope of buying back that hour when you're elderly. You're selling an hour of your, say, 36-year-old self with the hopes of buying that hour back when you're 66 or 76. How do you know you'll even be able then or even be around then? That right there is a really bad trade. You're deferring the ambition and potential and opportunities that you have in this one life of yours, and that's more damaging than deferring tax is favorable. So don't buy these tired lines about tax-deferred compound interest. But a lot of people participate because the scarcity mentality is abundant and the abundance mentality is scarce, or that people just don't care. You do care because you're here. So adopt leverage, arbitrage, cash flow, and a multifaceted investment class. If you want to learn more about Daniel Ameduri, check out futuremoneytrends.com/save. Until next week, when I'll be back to help you build your wealth, get paid now and later, not later maybe. Financially free beats debt free. Do the right thing before you do things right. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.